Have you heard about the stock market chart that compares 1928, 1929 to present day, 2013, 2014? This is Matt Kennedy from the Presley Group. Mark Hulbert with MarketWatch.com has done the comparison, and it's kind of eerie. Mark Hulbert joins us coming up on Your Money Matters. Plus, do you need long-term care coverage as part of your retirement plan? We'll discuss it next on Your Money Matters, presented by the Presley Group.
And welcome back to Your Money Matters, your weekly peek inside the complex financial world. You listen to the show so you can retire with peace of mind. And what better people to tell you about that than Christy Smith, president of the Presley Group, and Matt Kennedy. Christy and Matt are experts at helping you plan for a successful retirement. They teach their clients how to position their retirement money to avoid losses due to stock market conditions. They have helped hundreds of clients achieve their retirement goals, and they can help you. Here are your hosts for Your Money Matters, Matt Kennedy and Christy Smith.
Good morning and welcome to Your Money Matters, brought to you by the Presley Group. I'm your host, Christy Smith, joined with my co-host in studio this morning, Matt Kennedy.
Well, good morning. Today we're going to talk about a lot of stuff. Like I said earlier, Mark Hulbert, publisher of the Hulbert Financial Digest, will be here. His article about the scary parallels between 1929 and today in terms of the stock market, it is the most read article right now at MarketWatch.com, so he'll be our guest in just a few minutes to talk about that.
And before we get started in that, Matt, I want to talk about our website. Our marketing director, Taylor Clark, has done a fabulous job on our website, and many of you may have visited our website in the past, but if you haven't seen it recently, it has a new look and a lot of great information. So I want to encourage any of you listening today to hop on our website at your convenience, safemoneyplan.net. You know, what I find is that, you know, many people are looking for information, but they're scared to take that step and pick up the phone and call because they think that by doing that, we're going to start hounding them. You know, it's like put your dukes up and find information where you can. But at the Presley Group, we're so committed to making a difference that we really want to make that information easily available to you. So we've got a new link on our website, safemoneyplan.net, and it's called the Learning Center. Now, the Learning Center is designed for you to be able to go in and look at different topics and click the link and start getting valuable information. Now, don't think that by going to our Learning Center, that means we're going to start calling you every week, because we absolutely are not going to do that. But what we do want to do is we want to be different than those other advisors out there. Some are even on the radio. We want to be different because we want to be the ones that are constantly striving to really make a difference. And that means providing you the most honest, updated information available. And we can do that right now on our website, safemoneyplan.net.
Among the things you can find there, Taylor put up something called the 10 things you need to know about planning your retirement income. Because once upon a time, what really mattered was, how big my nest egg is. Now, it's not about how big your nest egg has grown to. It's about, will the money support me during retirement? Will the money last as long or longer than I do? So if you go to safemoneyplan.net, inside of the Learning Center, you'll see a link there for the 10 things you need to know about planning your retirement income. It's a free download. Simply fill out a short form and you can download that information. And while you're there, there's also a button for Ask Christy.
Ask Christy is a way for you to communicate with us and get your questions answered in a non-evasive, non-threatening way. Ask Christy simply means you can send us a question, we'll answer it quickly, and if it's a question that we think can help many of our listeners, we will then read it on the air. Now, we will not give the name of the person that asked that question,
right.
But, you know, we like to think that if Susie has that same question, sends it in, and we understand, hey, you know, we get that question asked a lot. Let's address that on the air. And so we would then answer that question on the air as well. But let me tell you what, you are not going to find another website out there that is going to give you more valuable information than SafeMoneyPlan.net, because we are the retirement income specialists. Retirement income is the name of the game. And what you're going to see is that the shift has already started occurring. No longer are the days we're worried about how much money do we have to have. Now our concerns and your concerns are, how much money do I need so that I can have a guaranteed retirement income that I cannot outlive? And we have tools that we can use right now to help you accomplish your goals. It's a matter of you taking that step. Maybe that first step is going to the website. But, ultimately, the best way to let us help you create a plan to guarantee retirement income is going to be to pick up the phone, give us a call, and schedule a complimentary visit. Now, that visit is totally complimentary. Doesn't mean you have to come in with your dukes up, because we're going to try to sell you something and get your money moved in a hurry. That is not the way we work at the Presley Group. We're here to help. And really, Matt, in order to help, you have to listen. So that first visit is going to be designed for us to sit down and talk with you one-on-one and find out, what are your hopes? What are your dreams? And let us use the tools that we have available. And we have many, many tools, because we are independent agents. We have access to hundreds of different plans. So we can find the right tools that are going to suit your needs and accomplish your goals. But again, it always takes that first step. Now, Matt, before we dig into how to look at long-term care insurance, I want to say, on the air at the beginning of January, I told you, I said, Matt, I'm going to lose 40 pounds this year, didn't I?
How you doing?
Well, I said, I'm going to join Medifast this year, didn't I?
Have you?
That's what I'm saying. I have not.
Christy
I have not
Smith.
done either of those. But you know what? The reason I haven't is because I have to take the first step, call them, and get that visit. Well, guess what? They're right next door.
You've been
I'm
busy.
going to take that step.
Yeah.
You know what? We're all busy. We're all busy, and this applies to every aspect of our life, not just losing weight, not just retirement planning. There's so many things that we need to do. We know we need to do them, but we just don't do them because being busy is a very good excuse. But you know what? Next week, when we're on the air, I want you to say, Christy,
did you call
Medifast and get your appointment? Because even in my own personal situation, we have to make we have to take the time to do the things that are most important to us. And we simply can't let things that are important lag behind, because we get caught up in the moment. Losing weight to me is very important. Not because I want to look good. I look good now. What I want to do is I want to feel good.
Health.
And I want to be there when my 12-year-old daughter has her first grandchild. It's about my lifestyle. Well, you know what? When we're talking about retirement, and we're talking about retirement income and retirement needs, we're talking about lifestyle. And lifestyle needs to be your number one concern. Planning for retirement should be a high priority. And many of you don't know that you may have options available to you, but you do. A lot of you have previous 401ks that you've left behind at different jobs. You've rolled them into IRAs, don't really know what to do with them. You're not maximizing them, and we can help. How many of you are approaching retirement? Maybe you're 5 years out from retirement. Maybe you're 59 years old, and you say, you know what? I didn't know that I could take some of my 401k money and I can secure it now. There's lots of things we can do, but you don't know unless you know. And the only way to know is to take that first step. So pick up the phone, give us a call, schedule your complimentary visit. Our phone number is 791-5773. Don't be like me. Don't put it off. If I would have done what I was supposed to do 3 weeks ago, I'd have already lost 5 pounds.
Maybe 6.
Now I'm behind. But you know what? I'm not going to let that stop me. I'm going to take that step today. I'm going to get into that Medifast office next week, and I'm going to start making a difference in my life. And you should start making a difference in yours.
And I'm going to hold you accountable, okay?
Well, you know, normally
Fair
when
enough.
I make my mind up to something, I do it.
You do. Let's talk about long-term care. Last week on the show, we mentioned that one of the big concerns for retirement planning is long-term care. Now, some of you know exactly what long-term care is, but I don't want to make the assumption that everyone listening knows what long-term care is. So the first thing, Christy, is let's start with a definition. When it comes to retirement planning, what is long-term care? What is it?
Well, long-term care is used when someone has a prolonged physical illness, a disability, or a cognitive impairment. A lot of times people think that when they get 65 years old, the magical number to get us onto Medicare, they believe that now the worries of having to pay a lot of money out of pocket for medical expenses are going to be covered.
Right.
But the facts are our Medicare system is not designed to pay for a long-term service. A long-term service would be needed for something like Alzheimer's, maybe a stroke patient, maybe a chronic condition that doesn't allow you to get up and move around. There's lots of reasons why we need long-term care services. But the sad fact is, Matt, is that most Americans think that they will never need it. So what do? They don't address it. They just put it off and it's in the cloud. But guess what? Statistics prove that 1 out of 2 will need it. 1 out of 2. So either me or Rick is going to need it. Now, we have to decide what is the best way for us to plan for that illness or that situation.
Let's talk about that in a second. Let me give you a quick number, though, because statistics, they don't lie. In 1940, the average American only lived in retirement about 10 years on average. Today, the average American will spend 24 years in retirement. Christy, some people are going to spend more time in retirement than they spent in a career at a certain job. And because life expectancies are so much longer, when you do get sick, the cost is skyrocketing, as you know. So it's a stunning statistic. And the stat that you gave earlier, 1 out of every 2 people are going to need some form of long-term care. And of that number, half of those people will be in a long-term care facility or need long-term care in their home for a year or more. You want to talk about destroying your wealth? You want to talk about draining your IRAs and your savings? Having to have long-term care expenses covered out of your pocket will absolutely devastate your savings.
When we look at the cost of long-term care services, Matt, I think it's important that we address what types of services are available that would really fall under the umbrella of long-term care services. Number one, we have home health care. Home health care is where, we all dream of the day where we can stay in our home until we're no longer here and live out our days peacefully. But a lot of times that is going to require that we hire someone to come in and help us take care of those costs, those services, those needs.
Right.
In addition to that, we have assisted living facilities. Now, this is the new wave of the future. Assisted living facilities are really designed more for people that are still somewhat independent, can take care of themselves, but yet they need to be somewhere where there's care available if necessary. These are the type of facilities where you see the 1 and 2 bedroom apartments, normally in very nice facilities, because the goal there is to transition.
Well, for example, here, St. James would be an assisted living facility, correct? And that's a name people are familiar with.
Well, St. James actually has all different types of levels of care. So St. James, you would break it down into either assisted living care, skilled care, or nursing home care.
I got it.
Some facilities are not designed only to provide, say, one type of service. But assisted living facility care is really the more common uses of long-term care right now. And then, of course, we always have to consider long-term care being in a nursing home. None of us want to accept the fact that a nursing home may be where we end up one day. But in some situations, a nursing home is clearly the very best option. So let's talk about how do you get the money to pay for that type of care? Because your Medicare benefits are not designed to pay for those types of services. We have to plan. And I'll tell you, the worst decision you can make is not to plan. With a very high statistic of 1 out of 2, you understand that one person can need this type of care and literally leave the spouse financially impoverished.
Absolutely.
So how do we plan for long-term care services? Well, we've got a couple of different options now. No, the first option is, of course, the federal government and the state government. I'm not encouraging this option because in order for you to utilize that benefit, you must be considered financially impoverished, and that would be our Medicaid program. You'd be very surprised how most people believe that when they need these types of services, it's very easy to qualify for those benefits. But it is absolutely not easy.
You have to be all but impoverished.
And the government is making it harder and harder. You know, the days of signing over the house to the kids and walking in a nursing home tomorrow are long over. And that's why it's important really to establish a great estate plan many years before you may even need long-term care services. But the next option available is to purchase what's called a long-term care policy. Now, a long-term care policy simply means I'm buying insurance from an insurance company that is going to, at some point, if I qualify for these benefits, pay for that type of care. Now, a long-term care policy naturally gets harder to buy as you get older because the insurance companies are going to look at your health conditions and the age when you purchase the policy.
It's like buying a life insurance policy in that you have to have blood tests and a physical and medical history and things like that.
And what we're seeing is that companies are really getting a lot tougher on issuing these types of policies. But one of the reasons I believe we have such a stigma to buy these policies is that we simply don't believe we're going to need the care, and we worry that if we buy a long-term care policy, we've spent a lot of money for something that we really didn't use.
I will tell you, though, the insurance companies have gotten smart, and now we have two new options. Once upon a time, you paid your premium, and kind of like term life insurance, if you didn't use it, well, it just went away. But there are two options out there that we like now, Christy. Option number one is a jointly owned policy, husband and wife. And if the husband, for example, doesn't use the long-term care, then the wife can use it. And she can use not only her benefit, but his as well. Say he dies suddenly at home and doesn't use that long-term care benefit. Now the wife has double the benefit. Or if he doesn't use all of his, but only some. So that's been one great improvement. And Christy, quite frankly, the newest revolution in long-term care is if you have significant assets, you basically put a lump sum deposit down. That lump sum deposit is your death benefit. So if something happens and you don't use the long-term care or you don't use it all, the monies left over become a death benefit for the family. Quick example. Let's say you put money in and your death benefit's $100,000. Well, the premium has been paid, and if you died without using the benefit, your family would then get a $100,000 life insurance policy. If you begin to use the benefits, it erodes that death benefit. A lot of clients like that because then they feel like they're at least getting something for their money if they don't use the long-term care.
And I think that's one of the biggest reasons long-term care insurance has struggled to spread its message.
Yeah.
Is because people don't want to buy something that they don't think they're going to need.
That's
they think
right.
it's wasting money. You know, let's talk about who should not buy long-term care insurance, okay? Now, we've got a great book that we're going to offer to you today. If you're listening to the show and you want to learn more about your options with planning and protecting for long-term care insurance, there's a shopper's guide to long-term care insurance available to you. We'll give it to you free. You simply need to call the office and say, send me the long-term care book. Our office number 791-5773. But who should not buy a long-term care insurance policy? Well, first of all, if you can't afford the premiums, don't buy the insurance.
If you have limited assets, if you don't have enough money in reserves to cover your emergency expenses, don't spend your emergency dollars on long-term care because you have to be committed to paying for it.
If your only source of income is your Social Security benefit, you probably don't need long-term care insurance.
Yeah.
If you struggle paying your bills, you're paying your utility bills, your food, your medicine, I would not consider buying a long-term care insurance policy because chances are you would qualify for Medicaid. Now, you should consider buying long-term care insurance if you have significant assets or income, because you're going to be the one that's going to foot the bill if you need this care.
And before you know it, your nest egg will be gone. You should also consider buying long-term care if you want to protect some of your assets and income. We talked about that. If you can pay the premiums and it doesn't impose a financial difficulty, buy it. And more importantly, Christy, if you don't want to be a burden to your family, long-term care makes a lot of sense.
It absolutely does. Now, listen, take the first step to learning about your options by giving us a call and letting us mail you a shopper's guide to long-term care insurance. It is a great book, 67 pages long, lots of great information, very valuable because it gives you names, phone numbers of different departments that you can contact to get other resources. Because again, long-term care insurance may or may not be right for you. And this book will help you determine whether a long-term care policy via a traditional long-term care policy or a life insurance long-term care policy may be right for you. But if you don't need it, this book is going to let you know you don't need it. So, hey, give us a call. It is a free book, 791-5773, 791-5773.
We'll come right back in a moment. When we come back, we'll talk to Mark Hulbert of MarketWatch.com about the scary, eerily scary stock market chart that mimics 1929. We're back in a moment. This is Your Money Matters, presented by the Presley Group. Social Security. You've paid into the system all your life. Now you're about to claim your benefits. Wait, stop. Don't make a $100,000 mistake. That's right. If you don't claim your benefits properly, you could leave over $100,000 in the hands of the government. It's your money. Get all of it. Attend a free Social Security Optimizer event presented by the Presley Group on Thursday, April 10th. It's free, so call 791-5773. That's 791-5773. Your Money Matters continues, presented by the Presley Group. Our website, safemoneyplan.net. Our phone number, 791-5773. Well, as promised, time now to talk about that eerie chart that shows 1929. Mark Hulbert from the Hulbert Financial Digest has the scoop. Oh, my goodness gracious. Has Mark Hulbert stirred up a firestorm, or at least in part? Mark, the headline in your wildly popular article is Scary 1929 Market Chart Gains Traction. Tell me about this chart.
Well, yes, be happy to. Now, this is a chart, I should give some background, that I first featured in a column 2.5, nearly 3 months ago, in late November, early December last year. All it does is superimpose a chart of the Dow Jones Industrial Average over the last 12 months on a chart of the Dow back in 1928 and 29, right leading up to, of course, one of the worst stock market crashes and worst periods in U.S. stock market history. And so at the time, I have to confess, I interviewed a number of statisticians and market professionals who poo-pooed the idea that this had any statistical validity whatsoever. I'm now revisiting the issue because, believe it or not, over the last 2.5 months, the market has continued to follow the correlation that was first at least identified in that chart 2.5 months ago. So it's not as easily dismissed now as it was then. If anyone thought that it was simply a shameless effort at sort of retrofitting the data to make it look like it was matching some previous period. And, of course, you can always play that game. You can always find periods where it looks like the squiggles of ups and downs and so forth are matching each other over different periods of time. The fact that it has continued to fairly closely follow the same script gives additional credence on the one hand, or if you want to be a skeptic, you can say, well, it still has no validity, but it's not as easily dismissed as people were doing 2.5 months ago.
I got to tell you, Mark, it's uncanny. And this thing has blown up on social media, and it's one of the most shared items ever at MarketWatch.com because this is radio. I can't show you, but if you go to MarketWatch.com and just type in Mark Hulbert or 1929, you'll find it. It is eerily similar, and what we're seeing is if this thing plays out perfectly to form, then the market will rally through the spring, and then in the summer will be the great crash of 1929, right?
Well, yes. Now, I do want to say that, and first of all, I myself am not a chartist or a technician. Those are the terms that Wall Street applies to those who look at chart patterns this way. What I do is track the performance of several hundred advisors, some of whom do look at this and have good track records. So I want to give them their day in the sun. And the two technicians that I quote in the column who actually deserve the credit for noticing this parallel, mainly a guy named Tom McClellan. He has a newsletter called the McClellan Market Oscillator. And then there's a fellow that indeed he in turn gives credit to, a guy named Tom DeMark, who has a well-known institutional service that looks at chart patterns and has a number of institutional clients. And what they will say is that the correlations don't have to follow each other in terms of magnitude. It's more the fact that the directions of the ups and the downs more or less follow the same, they're both marching to the beat of the same drummer, so to speak. And so what they would be the first to say and have said to me is that even if this correlation were to continue, and of course that's a big if, that doesn't mean that we're going to have a 50 or 60% market crash. It just means that we're going to have some significant losses and turmoil in the market. So I want to be the first to stress that a correlation like this, even if it continues, does not have to guarantee that we're having another crash. On the other hand, I don't want to sugarcoat it. It does mean that we're in for some real rocky periods over the next several months.
Our guest is Mark Hulbert, Hulbert Financial Digest. You can read his stuff online at MarketWatch.com. Mark, we're not math geeks, but does this chart take into account the fact that the actual number on the Dow was, of course, significantly lower than the number we're dealing with now? So the magnitude of the peaks and the valleys is not necessarily the same. I think you may have already said that. It's not so much the exact numbers, it's the direction, correct?
Well, that's right. And again, it depends on what kind of a chartist or a technician one might be, and in terms of how you might answer that question. I will say that the statistics behind it are such that it doesn't matter so much the magnitudes, but rather the direction to the squiggles that leads to some impressive statistics that measure the degree of correlation between the two series. So again, it was one of those things that when I was first wrote about it in late November, early December, it was one of those ways in which people were able very condescendingly to dismiss the correlation and say, well, the chart magnitudes are entirely different, so therefore it has no validity. But it turns out, I guess my major plea that I think I try to reiterate in my column this week is that we may want to end up dismissing this. I don't want to prejudge that. On the other hand, we can't so easily dismiss it on the grounds that the magnitudes are different or that it's a shameless retrofitting of the data to match some prior period. Both of those charges don't have a lot of force right now, and I think we need to squarely face either it means nothing because we don't think charts ever mean anything, A, on the one hand, but if you don't believe that, then we're going to have to at least open the possibility that the market is playing out some sort of pattern here that bears very close attention.
Do you think this market is overbought? Do you think the price-to-earnings ratio, for example, on the S&P is out of line?
Well, that's right. Now, again, I should always qualify what I say because what my main job is tracking the performance of the people who do think they know the answer to that question, as opposed to myself claiming that I know the answer. On the other hand, that's never stopped me from offering an opinion and won't now either, and that is I do think that valuations are stretched too high right now compared to any market norm that you want to look at. Again, it depends on any of a number of issues on how you define valuation. One of the most popular is a ratio of the price to the earnings that corporate America is able to produce. The price-earnings ratio, again, is a very popular measure, and some people look at forward earnings, some people look at trailing earnings. You can come up with all kinds of complications, but if you do an apples-to-apples comparison, I think it's hard to claim that the market is fairly valued right now. I think we're either moderately or even more than moderately overvalued right now. And coupled with the fact that we've gone now for several years without even a 10% pullback, and history suggests that 10% pullbacks in a bull market are entirely healthy and normal. And in fact, I think the statistics show that on average you get a 10% pullback once every year. And we've now gone, I think it's, you have to go back 2 or 3 years to find a 10% pullback in the market. The pullback that we had in late January, early February, again, depending whether you look at the S&P or the Dow, measured around 6%.
Mm-hmm.
And that was scary enough. Boy, it got a lot of people's attention, but nonetheless was only about half as big as what is otherwise thought to be normal. And I think the problem with this market, above and beyond the valuations, which I think is problem enough, is that when investors who we just like all of us, we have short memories, don't remember that a correction is normal. Then when we do start getting something like this, they can start running for the hills very, very quickly and think the world's coming to an end when, in fact, it's just an entirely normal pullback.
Our thanks to Mark Hulbert, Hulbert Financial Digest, and MarketWatch.com for the great insight. By the way, this has become one of the most read and most commented on stories ever at MarketWatch.com. If you visit MarketWatch.com, just type in Mark Hulbert, Hulbert, and his latest article about this eerie similarity in the chart movement between now and 1928-29 will be right there on the website. You got to see this chart for yourself to believe it. It's wow, it's very interesting. And so the question becomes, like Mark was saying, is it just a chart? Does it mean anything? Well, certainly you've got a plan, right? Plan for the worst, hope for the best. It's kind of the motto we live by at the Presley Group in helping you prepare for a financially secure retirement in any economy. So if you're closing in on retirement, or if you're already retired, give us a call. Let us show you how the tools we use, the fixed indexed annuity strategies, can protect you if this chart does come to fruition so that you don't put your principal at risk. And if the chart's wrong and the market keeps going up, hey, great news. You'll share in those gains and create guaranteed income. To schedule your free one-on-one consultation, call us at 791-5773. That's 791-5773, or visit safemoneyplan.net. Back in a moment, Christy Smith and I return for segment number 3 next of Your Money Matters, presented by the Presley Group. Back on Your Money Matters. Thank you for joining us, Matt Kennedy, along with Christy Smith. Before we talk more about Mark Hulbert's 1929 stock chart, just a reminder, April 10th, 6:30 p.m., 6:30 p.m., April 10th, that's a Thursday evening here in Baton Rouge, we're going to have a great event, a free event. It's designed for those of you who are on the cusp of retiring and you want to make sure you're optimizing your Social Security benefits. A lot of people think there's only 2 strategies for claiming Social Security. I claim early or I claim at my full retirement age. There are actually about a dozen different scenarios for claiming your benefits, and you want to maximize your benefit. I mean, after all, you paid into the system. Certainly you want to get all the money back from the government you can. Well, this event on Thursday, April 10th, is designed to help show you how to maximize your Social Security benefits. To attend, it's free. Simply call us at 791-5773. That's 791-5773, or you can register at safemoneyplan.net by shooting us an email. Simply say, I'd like to attend the event on April 10th. Optimizing your Social Security. That's the event, and we'd love to see you there, 6:30 p.m. on April 10th. All right, Christy, back to this chart that Mark Hulbert talked about last segment. It's a chart where you take the stock market between 1928 and 1930, and you overlay it with the recent 3 years of the stock market, and they look eerily similar, the pattern of the market. Now, Mark Hulbert, as he said last segment, isn't saying the market's going to go through a 1929 crash. He's just pointing out you always have to be prepared for what might be down the road. What's the old saying? I know I'll mess it up, but, you know, those who don't learn from history are doomed to repeat it. I think that's kind of the saying. All Mark Hulbert is saying is be careful. Keep your head up. Keep your chin up. Know where we're going, look at some of the signs, and number one, be prepared.
And also, too, when we listen to our federal chairwoman, Janet Yellen, that would lead us to believe that we may, in fact, see another good year on Wall Street. But the facts are is that none of us really know, because while the federal government can somewhat control interest rates, they can't control other things. They can't control whether or not we suffer a terrorist attack.
They can't control the emerging markets.
That's exactly right. And we are all intertwined now. I don't like to talk about fear and doom as a reason for making change. But what I do want you to know is we're hearing more and more often that, your concern is that the market has been on a high and we may see a pullback in the near future. And are you really prepared to suffer that pullback if, in fact, you're going to retire within the next 5 years? Most of you would say no. Most of you would say, I can't stomach another 2008. Okay? And I'm not saying that's going to happen, but what if it did?
One of the things, Christy, that I've been reading a lot at CNBC and MarketWatch and other places, Wall Street Journal, is Americans who are approaching retirement are much more trigger happy than they once were. Let me explain. Once upon a time, the market went down 7%, 8%. Most Americans, even if they were nearing retirement, said, it'll come back. But after what happened in 2008, something new has been happening. Americans, when the market went down a ton in January, pulled billions of dollars out of equities. But here's the problem. Right when you pull that out, the market sinks, right? Then the market roared right back up. Now if you get back into those same equities, you're having to buy them higher, and you've missed the run-up. But Americans are much more cautious about staying in a down market. Now, if you're 25, 35, even 40, ride it out. But if you're within 5 years of retiring, wouldn't it be nice to say a portion of my money is in a plan where if the market goes down 7 or 17 or 27 or 37 or 47%, I'm not going to lose a dime. That's what our tools do.
And we're starting to see that more and more often. We're starting to see a shift. Last year, I've been doing this, Matt, for 17 years, and last year was the biggest year we ever had. And the reason for that is because people are starting to be more smart. They're starting to plan more. Now, you may say, okay, I don't want to get rid of all of my market risk. I want to simply secure some of it. And a lot of times it's even a strategies that we use that we will shift some to safety and some into an income plan slowly each year as you get closer to retirement. And so we may look at someone that's going to retire in 2 or 3 years and pull some of it this year, some of it next year, some of it the year they actually retire. And so it's not something where you have to make a total change right now. But the worst thing you can do is do nothing, because many of you don't realize you do in fact have choices. If you're over 59 and a half, and you are working for a company and you are participating in your 401k plan, well, first of all, I applaud you, because we want you to do that. Most companies are going to give you a free match, and we never want you to turn down free money. But what we do want you to consider is the impact of a major downturn. If we had a major downturn right now, how would it impact your retirement plans? So we can look at using an in-service distribution and possibly take some of that money and put it to the sideline. You may think putting it to the sideline means no growth. But I'll tell you, I did an annual review yesterday for a client that has used one of our tools for the last 3 years. And last year, in fact, he made over 17% compounded interest in his income plan.
He was linked to the S&P.
He was linked to the S&P. But we don't have to use just the S&P, Matt. There's lots of different indexes that we can use. What you need to do is think about where you are now and where you want to be at retirement, and how can we get you to the point where you can accomplish your goals. You simply have to take different actions. You can't do the same thing. The definition of insanity is doing the same thing, expecting different results. Right. You can't get different results if you're doing everything the same. Yeah. You need to pick up that phone, schedule a visit to come and meet with us. And I'll tell you, you probably hear 3 or 4 other shows out here on the radio. We hear people come in all the time. You may say, what makes you different? Well, I can tell you, walk in the door, you'll know what makes us different, because we are not like the other shows you're going to hear on the air. We are not salesmen. We are here to teach you what we can do and really bring value to your life. And we will do that if you take that first step. Give us a call and come in to meet us. Our office number is 791-5773. 5773. And if you just want the Shopper's Guide to Long-Term Care Insurance, give us a call, 791-5773.
Hope for the best, plan for the worst. We need to put that in the front office.
Well, my kids would tell you, Matt, one of the qualities that they don't like about me is that they would classify me as what I call a realist. Now, I don't know if a realist is a real word, but I'll tell you that in raising my children, and I have 2 children that are in college right now, making lifelong decisions, okay? And when I talk to them about their future, I always talk to them about how do I make decisions. I make decisions that are going to impact my future based on worst case scenario. And the reason I do that, you might say, oh, so you're one that the glass is half empty. No, in fact, I'm actually one that the glass is half full. But when I make a decision about my future, something that's going to affect me, I'm always going to consider the worst case scenario. Because if I can handle the worst case scenario, and believe me, I want to know what that worst case scenario is.
Exactly.
If I can handle that, then I know I can move forward and make a good decision.
Which is why when you come in to see us, we'll teach you about the tools that we use, the fixed indexed annuity tools that never, ever put your principal or your annual gains at risk. That way you can say, Christy, Matt, I want to set aside X number of dollars because I need this money safe and growing safely. And then you might be in a situation where you need retirement income. And last but not least about our tools that we use, Christy, you heard Janet Yellen, or if you didn't, I'll tell you, the federal chairwoman said, she said, we're going to keep short-term and intermediate interest rates at record lows. What does that mean? It means you're not going to see CD rates going up anytime soon. If you're sitting out there and you're about to have a CD that renews, or you've got a CD and it's making you 0.5%, you're losing money. You don't think you're losing money, but you are, because inflation is running at about 2%. So every year you're making 0.5% and inflation goes up 2%, you're in effect losing 1.5% of your buying power. Come see us, because those CDs that are doing nothing will have the potential to do much greater using our plans. So whether you need to protect IRAs or 401ks for your retirement income, or if you're just sick and tired of earning nothing, and by the way, rates aren't going anywhere for 2014. They're just not going to go anywhere, because the powers that be, Christy, they're afraid to raise interest rates. They're afraid we'll stop buying. Well, low interest rates help buyers. They hurt savers. Come see us. We'll show you how you can do so much better than CDs.
While retirement planning is really what we specialize in, Matt, we also are able to help those of you who are already retired and simply have a nest egg that you've saved. It's for a rainy day, or maybe it's to even pass on as a legacy to your family. Don't think that we don't have tools that can be perfect to help you with that as well. Think about it. Low interest rates, no growth.
None.
You've got to learn. You owe it to yourself. You've got to learn what is out there different. Remember, we can't do things the same we did. We're in a new economy. You need to learn what's available and let us help you. Just let us help you accomplish your goals.
Let me tell you a quick story my dad used to tell all the time. My dad loves this story. So this lady was getting ready to cook a ham for Thanksgiving. And she had the ham all out, and she would cut the end of it off. And her daughter said, Mom, why do you cut the end off of the ham? I don't know. My mom did that.
Because she always did it.
And she said the next time she saw her mom, Mom, why did you always cut the end off of the ham before you cooked it? I don't know. Your grandma did that. Go ask her. So she went to ask Grandma. And what did Grandma say? Because my pot was too small.
That's hilarious.
No, but my dad's point was we fall into habits of just doing the same thing over and over and sticking with the same tools we've always used because that's what we've always known. Come see us. Let us teach you about fixed indexed annuities. These tools can be great should and if Mark Hulbert's 1929 chart come to fruition. You can call us for your free, no-obligation consultation at 791-5773. That's 791-5773. And remember, we're always online at safemoneyplan.net. We'll be back to wrap up the show in just a moment. This is Your Money Matters, presented by the Presley Group. Social Security. You've paid into the system all your life. Now you're about to claim your benefits. Wait, stop. Don't make a $100,000 mistake. That's right. If you don't claim your benefits properly, you could leave over $100,000 in the hands of the government. It's your money. Get all of it. Attend a free Social Security Optimizer event presented by the Presley Group on Thursday, April 10th. It's free, so call 791-5773. That's 791-5773.